I'm honored to have this opportunity to speak to you all. I will start by recapping the current global economic outlook. Then I'll share some of my views on monetary policy in Turkey and its effects on the banking sector. I'll conclude with a few remarks on participation banking and recent advances in financial technologies. Distinguished guests, we are at the peak of the global tightening cycle. Inflation has come down throughout 2023, but it remains above the targets of central banks. Growth slowed in response to tight financial conditions. In addition, geopolitical tensions increase inflation risks by raising short-term volatility in energy and commodity prices. Geopolitical tensions further create risks to long-term growth prospects due to the ongoing trend towards economic fragmentation. A decade ago, a tightening in financial conditions in advanced economies, the likes of which we have seen recently, would have had significant spillovers to emerging markets. However, owing largely to improvements in monetary policy making, central banks in emerging markets have become far more able in alleviating global risks. First, more and more central banks are doing explicit inflation targeting. As such, they tightened policy significantly in response to rising inflation in the aftermath of the pandemic. Second, improvements in the global financial architecture and domestic policy frameworks led to lower exposure to volatility in capital flows. Let me give one concrete example of such an improvement. According to a recent OECD report, the share of foreign currency denominated debt issuance by emerging market treasuries fell from 15% in 2005 to just 4% in 2022. This does not mean that we're done in terms of improving the resilience of financial markets and emerging economies. For example, the use of local currencies in bilateral trade remains limited. Increasing this would further raise the resilience of domestic economies to global shocks. Therefore, given the interconnectedness of our economies and financial sectors, we need to continue to improve our regional cooperation. I was in Qatar last week for the Qatar Economic Forum, and the discussions there also focused on where we can improve cooperation. I also believe that the Istanbul Financial Center will become a regional center and help enhance cooperation in financial technologies and architectures. Distinguished guests, as you know, the situation in Turkey diverges from the global outlook, with inflation as the overarching issue. The latest April reading was 69.8%, and we expect inflation to reach around 75% in May due to base effects. To reestablish price stability, we began a tightening cycle last June and have already seen significant improvements in the current account balance, in our FX position, some signs of moderation in domestic demand, and an increasing preference for Turkish lira financial assets. We expect to see a sustained decline in headline inflation starting in June. This decline will in part be due to base effects during the summer months, but will also be sustained through the continuing improvement in the underlying trend of monthly inflation. Our yearly inflation forecasts, which also serve as interim targets around which we calibrate our monetary policy, are 38% for the end of this year, 14% for 2025, and 9% for 2026. Going forward, we will need to maintain a tight monetary policy stance until a significant and sustained decline in the underlying trend of monthly inflation is observed and inflation expectations converge to our forecast range. Monetary policy stance will be tightened in case of a significant and persistent deterioration in the inflation outlook. Our firm monetary policy stance will bring down the underlying trend of monthly inflation on the back of rebalancing domestic demand the real appreciation of the Turkish lira, and the improvement in inflation expectations. Esteemed participants, we know that monetary tightening cycles bring challenges to the financial sector due to the subsequent slowdown in real economic activity, and rising uncertainty over banks' asset quality. However, the banking sector will be among the main beneficiaries of the disinflation in Turkey, as both the households and corporates have very low levels of debt, both based on cross-country comparisons and historical data. As price stability is established and confidence in the Turkish lira increases, the low level of debt means there's a significant room for the banking sector to grow. In our case, the complex set of micro and macroprudential policies that we have been gradually simplifying further place the burden on the banking sector in managing their balance sheets. Fortunately, one of our biggest advantages is the resilience of the Turkish banking sector and the agility with which our banks manage their assets and liabilities. This resilience dates back to the 2001 crisis and was strengthened in the period after the global financial crisis. Turkish banks have since increased the overall quality and quantity of risk-based capital and begun to maintain ample liquidity and provision against balance sheet risks. We also have a complete and up-to-date set of banking regulations that are well in line with Basel III regulations. More traditional measures of banking sector resilience confirm the soundness of the financial system. The sector's capital adequacy ratio is strong and above the regulatory thresholds. Capital structure mostly consists of common equity Tier 1. As of March 2024, the banking sector's capital adequacy ratio is 17%, far above the 8% minimum limit in Basel regulations. The common equity Tier 1 is above 13%. The sector is also large with a healthy asset and liability structure. The asset size of the banking sector exceeded 25 trillion Turkish lira, approximately $804 billion, as of the end of March 2024. The share of loans in total assets is at 50%. Asset quality is high, and the non-performing loan ratio stands at historically lows, around 1.5% as of March 2024. The sector holds a deposit-denominated liability structure, meaning that its funding is relatively stable. As of March, total deposits accounted for 66% of total liabilities. While the share of FX and FX-protected deposit remains high, we are seeing a significant rise in the share of Turkish lira-denominated deposits. According to our latest data, the Turkish lira-based deposit share increased to 45% from its low of 31% in August of last year. Moreover, despite the high inflation environment, the banking sector maintains strong profitability, which supports banks' core capital. Although profitability has somewhat declined during the hiking cycle, the sector continues to be profitable in terms of return on equity and return on assets. The sector never had significant issues accessing global financial markets. The resilience has in part been the result of diversification in lenders, debt instruments, and maturity structure. The share of external funding in total liabilities stands at close to 15% as of March 2024. More recently, the hiking cycle and improving global confidence in our disinflation path has also improved the outlook in external financing. We are also observing an increase in foreign investors' appetite for Turkish banking sector's debt instruments on the back of policy normalization and declining trend in Turkey's risk premium. Public and private banks have issued a large number of long-term Eurobonds in 2023 and this year. Eurobond issuances have reached approximately $13.8 billion since September of last year. Since the beginning of this year, the total Eurobond issuances amount to $7.8 billion, and total subordinated debt issuances amount to $4.1 billion. In addition, banks are rolling over their syndicated loans at favorable conditions. The rollover rates in the syndicated loan market has been around 130%, with a 175 basis point decline in risk premium compared to last year. Our monetary policy will continue to support the growth of the banking sector. We have thus far realigned macroprudential regulations to complement monetary tightening. These regulations serve to sterilize excess Turkish lira liquidity, support the transition to Turkish lira deposits, and safeguard against excessive credit growth. However, we are in a transition phase, and we realize the costs imposed on banks due to the distortionary nature of macroprudential regulations. That is why, along with the hikes in policy rates, we have explicitly stated that the simplification in the macroprudential policy framework will be a policy objective going forward. To that end, we have recently abolished all of the remaining security maintenance requirements, which were impeding the healthy price formation and market functioning in the Turkish lira bond market. Distinguished guests, before I end my talk, I'd like to share a few thoughts on Islamic finance and recent developments in financial technologies. Let me first start with a clarification. We call Islamic finance participation finance in Turkey, and banks that are governed accordingly are called participation finance institutions. The market share of participation finance has been rising in Turkey and is at 8.7% as of March. However, there's still much room to grow. Indeed, the recent IFSP data reveals that Turkey has just 2.8% share in global Islamic banking assets. The asset size of the market globally is expected to reach $3.7 trillion by the end of 2024, according to a recent report by the Islamic Financial Services Board. We see significant potential contributions from the growth of participation finance for the Turkish economy. First is its obvious role in raising financial participation, diversifying Turkish lira financial assets, and deepening capital markets is a key objective to support financial stability going forward. Second, instruments in Islamic finance tend to be easier in terms of risk management, which again is a plus for financial stability. Finally, Islamic finance is growing globally at a steady pace, and we would like to make sure that this is a market that Turkish banks and corporates can access. We therefore remain committed to support the establishment of the necessary financial and regulatory infrastructure that will allow participation banks to grow further. For example, we have been trying to level the playing field across participation and conventional banks by specifically tailoring our regulations for participation finance institutions. We further provide technical assistance and support to other regulatory bodies in fine-tuning the financial architecture to better accommodate participation banks. As you may be aware, we as the CBRT are also responsible for the safe functioning of the payment systems in Turkey. Our instant payment system, FAST, and its security overlays continue to be improved in-house, while work on the digital Turkish lira continues. New challenges and opportunities continue to emerge in this field as financial innovation is now receiving a further impulse from the emergence of AI applications. As a CBRT, we are now adopting AI in ensuring the security of our payment systems through the Instant Payment Systems Overlay called CPR. AI's advantages in rapidly processing large data and detecting anomalies presents an important opportunity in detecting suspicious transfers. We are also aware of the risks that financial technologies pose to payment systems and even to financial stability at large. Going forward, we will need to continue to keep up with financial technologies as a regulator. The financial sector is innovative and quick to adapt to any new innovation, meaning that the regulators have to adopt a similar approach in building safeguards. Let me conclude by thanking you all for coming to Istanbul and attending. Looking at the agenda, I'm sure that this event will prove useful for all attendees and hope that we see you in Istanbul more frequently.